the record button. Very important tonight because I would imagine I only have 4. And I do appreciate everybody coming online, collaborate on their spring break week at that, and being part of the class. Yes, hello, Sarah. Hope everyone is doing fine. But again, you get the class over with tonight, and you'll have next week to next week off. Hello, Heidi. I hope everyone's doing good. And again, I appreciate the alterations in the schedule here. So I do want to thank everybody. Hopefully everyone can hear me okay. We may have 1 or 2 come on yet as we move along here, but I'll keep an eye open just in case. But let's see. Anybody have any questions then on chapters 8 or chapters 9 from last week, Thursday, when we went through cash and accounts receivable? Anybody have any questions on anything there? Good. Excellent. Good. Thank you, everybody. Now, I do have 3 dogs, so I will warn you that you'll be hearing probably more barking than not. It's due next week, though, right? Oh, I'm sorry, Sarah. What would be due next week? Chapters 8 and 9, according to this. Yes, you are absolutely correct, Sarah. Yes, the homework for chapters the homework for chapters 8 and 9 is due on the 21st of March. You are correct. Yes. Had to look at my own syllabus to see if if I stated that correctly. Yeah, because actually this is supposed to be spring break week, Sarah. So yeah, you would get that extra week to have that done. Then be aware of the fact that your chapter 10 homework will be due on March 28th. And there is also a quiz 4, that'll be due on the 28th as well. So those will be. Now I can open those up tonight if you want them open, seeing that we're going to be getting into the lecture. Would you want them open tonight, or you want me to? Would you like to wait? Okay, I can open them up tonight then, and so if you want to work on them, you can go right ahead and work on them. And again, I'll have to probably I might do it during a break. It's not that much hard. It's not that hard. But let's see, they should be, once I open them up. Now, I will open them up so they open at 9 o'clock tonight. So just like a normal homework assignment or a normal quiz on a regular, on a normal school night. So they won't be opening right away, but they will be opening at 9 o'clock tonight. All right, so again, we'll be talking about chapter 10 tonight. Plant assets, natural resources, and intangible assets. Okay. We will be looking at, I might get into some in-class exercises tonight. Seeing that we only have 1 chapter, it may be doable for tonight. I'll have to wait and see how the night goes here. Next week, or on the 28th then, will be chapter 11. We get into liabilities, current liabilities and payroll liabilities. So we'll be getting into that in week 9, and then we leap to chapter 14 in week 10. That'll start off in April on long-term liabilities. A lot of that will be talking about long-term notes payable and bonds payable. I don't know if anybody knows anything about bonds, but you will after that class. And then on week 11, we'll bounce back a chapter and get into accounting for corporations on chapter 13. And that'll deal with stockholders' equity. So we're used to a equity account just having a capital and a withdrawal account. We'll be completely changing that. We'll be doing a makeover on the last week of the semester, talking about stockholders' equity for corporations. So be a little different there. But anybody have any questions on the calendar as we move forward? Oh, thank you. Sarah's on the bus. Good, 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 good. Thank you, Heidi. Thank you, Nicole. Thank you, Melissa. Excellent. So, all right, we'll get moving then. And by the way, again, I have to mention my two favorite flavors of ice cream in my lecture somewhere. So if it's getting towards the end of the lecture or whatever, and I haven't mentioned anything yet, just somebody just kind of briefly remind me what I need to do in order uh, to state what I was going to state, and so there's something that these other that's a good one too, Sarah. That is a good one too. Yes, I like Blue Moon myself. Tastes like Fruit Loops. If you ever had Fruit Loops, it tastes like Fruit Loops. But yeah, I'm not going to mention that one. That I was close to mentioning that one, but I'm not going to mention that one. But yeah, that is a good one. All right. So let me put the calendar away if everyone is okay there. And then again, if you would have any questions on chapters 8 or 9 that you would want to send me an email. I know some of the discussion questions. I know Melissa was on the discussion question board this week, and there were a couple of problem-related questions that was on the that was last week's discussion questions. So we should be good there. And again, Melissa, you're all set. I know we were going back and forth a little bit there, but you're all set for participation for last week. All right, you are perfectly welcome. Let's see here. Let's see what type of trouble we can get into tonight. We're going to be talking um, again about the fixed assets of a company. We've been talking about cash, which is very liquidable. It's the first asset you would see on the balance sheet. Cash equivalents, marketable securities, or short-term investments. We've been talking about accounts receivable. We should know what that is. Um, accounts receivable, inventories. We've been talking about certain inventories. These all make up what we call current assets. And the only other item I can think of in that area would be prepaid expenses. We talked about that when we talked about accrual accounting. So now we're going to go over, we're going to stay in the asset section. We're talking about long-term assets. And when we talk about long-term assets, these are assets that are going to be on our books for longer than 1 year. So like plant assets, um, and then it says natural resources, but when we'll be talking more in depth about depreciation expense in this chapter. Be aware of the fact if we talk about natural resources, we're going to be talking about depletion expense. So that's a little different. And then we'll talk about intangible assets. So again, a number of different things tonight. And as we move along and as we get going here, hopefully we can get into maybe some in-class exercises to kind of warm us up for the homework and the quiz. I think the quiz, I haven't looked at it in a long time. I think there might be a little bit on chapters 8, 9, and 10, if I remember correctly. So that will be all involved in the fourth quiz of the semester. So where are we going to tonight? We're going to compute the cost of plant assets. It's just not the plant itself, and that's all that we need to worry about. There are other things that are going to be included in plant assets that we need to determine what the value of those plant assets are. A number of different things that are added to not to the original fixed asset that we're going to be purchasing. Depreciation in partial years. Okay, that's going to be a little different. Normally, we don't buy all of our long-term assets in the beginning of the year, and we talk about full year's depreciation. There will be times where we purchase basically fixed assets all throughout the year. So it's being a little different there. We'll talk about changes in estimates. We can change depreciation methods if we would want to. it's probably very rare that we would do that. But if we do change depreciation methods, we have to change prior periods as well. There's reasons for doing it, but it's something kind of like inventory. When we talked about inventory values, we can change, but not, we have, it's a very rare situation that we would change methods. And then one of the problems that uh, businesses face, and I basically was part of an IRS audit due to the fact that the IRS felt that I did not label revenue expenditures and capital expenditures correctly in the books of our company. And I had a young lady come in to kind of look over our records to make sure that we were doing what we should be doing according to GAAP. And so, well, that's part of C3, and we'll be talking a little bit about that as well. Our flavor of the night, other than ice cream, is going to be apple. Oh, excuse Apple. Asset turnover. I was going to say apple turnover, but it's asset turnover. Okay, we'll be getting into that. And again, these are very important ratios that kind of determine how well we're doing as a company, especially asset turnover. How well are our assets doing? Are they remember, assets are investments. Are they generating revenue for us? That's the main reason why we buy equipment to basically manufacture products and sell to our customers. So as far as procedural, we will be computing depreciation. Straight line is the easiest method out there. A lot of companies use it because it's easy to use. That would be one of them I'll be looking at. Units of production will be another one, kind of like the one I like. I think it's a more accurate depreciation method. And then we're talking about something called double declining balance or declining balance. And we'll see exactly what that is. So we did touch a little bit about depreciation, I think in chapters 2 or 3, and we're going to be hitting it more in depth tonight. What happens if we dispose of an asset? Okay, how do we get that off the books? If we sell the asset, do we sell it for more than it's worth? Do we sell for less than it's worth? Okay, these are our journal entries we have to put together once we dispose of those assets. And again, we'll talk about natural resource assets and intangible assets. We'll get into that as well. And then I would like to get in Appendix 10A, account for asset exchanges. Not a lot in there, but there are some meaningful items, topics in there that we can kind of add to the chapter itself. So Appendix 10A, we will see a little bit of activity in there as well tonight. All right, with that being said, let's get rolling then into chapter 10. So when we talk about plant assets, it's kind of like what I was stating earlier. These are assets that are going to last a while, anywhere from over a year to 20, 30, 40 years. I mean, if we're putting a new building together, that's a plant asset. We're building an expansion, that's a plant asset, and that the cost of that building expansion or that new building is going to be on our books for quite a while, until we actually don't use it anymore, or the life of that building is at the end of its stages. So plant assets have to be tangible in nature. So when we talk about something being tangible in nature, we have to understand it's something that we can physically see. We can see a building. We can see equipment either in our office or in our manufacturing plants. Vehicles, we can actually see vehicles. Okay, we can touch them. Okay, so that would be something that's tangible. We will get into intangible assets later on in the lecture and kind of see what those are, but we'll be getting the tangible assets tonight, or just to start out our lecture. So being tangible, again, we can physically see it, we can physically touch it. That means it's tangible. It must be used in the operations. If we buy a machine, a brand new machine, and it's basically sitting in the corner doing nothing with a tarp over it, it's not used in operations and shouldn't be part um, of our listing of plant assets. It's not used in operations. It's not aging, okay? Therefore, it wouldn't be considered depreciable at this point. It must benefit future periods. So no matter what we buy as far as plant assets, being buildings or land or um, machinery and equipment or vehicles or whatever, land improvements, they must benefit future periods. And then they must be called plant, property, and equipment. So, I mean, there can be a thin line there if you're buying lampshades for your office, okay, that are $500. Do you capitalize that or do you expense it? These are some of the questions we have to ask ourselves, and we should have a benchmark within our company to determine what would be depreciable, um, basically depreciating in it for its useful life, or what we should just expense. So again, depreciable assets. We have a nice looking vehicle here, way to the left. Looks like a lady's buying a vehicle, brand new, shiny, new vehicle. I know my boss's boss had me come with him yesterday. He was personally buying a car for his son, and he wanted me to come along for the legalities of it. And I think he bought a brand new Mazda, something CX-7 or something like that. Beautiful looking car, but it was 6 miles on it, shiny new. That's what we're looking at here. We basically buy a new vehicle, we acquire it, determine what the cost of that vehicle is. And as we use that vehicle, we determine that it's getting, its life is getting, it's basically its value is deteriorating. So it's being depreciated over the useful life of the vehicle. So as we use the vehicle, we may allocate costs to upkeep the car. There will be expenditures that we're going to be using for maintenance and repairs or oil changes or whatever. But as you can see, when we get to the right-hand side, that car is looking a little rusty, looking like an old clunker that maybe can't even move anymore, but then it's ready for disposal. And basically it's at the end of its useful life. We might be able to sell it to somebody who would want it, or we just might be able to just get rid of it, maybe give it to Rawhide or something and get a donation. Who knows? But as you can see, plant assets, they have 4 useful lives. You've got to compute the cost of it, take care of it, allocate the cost to the periods benefited, keep it up to snuff more or less, keep it updated, account for the expenditures of taking care of it, and then at the end we have to dispose of our vehicle. And again, we're talking a vehicle here. You can put any plant asset in this picture and watch it being depreciated over the life of the asset's value. So let's compute then the cost of plant assets. And like I said earlier, the acquisition cost might be only the starting point to determine the value of a fixed asset. So whatever we're purchasing as far as a long-term asset, there's going to be a price on that. And it's usually should be, and normally it's going to be something that's rather expensive. We buy a building, it's going to be very expensive. We buy machinery, equipment, office machinery or equipment, it's going to be expensive. We buy a new computer system, it's going to be expensive. So be aware that's kind of the trademarks to a plant asset. It's something that we just don't buy every day. It's something that's unique in buying. So an acquisition cost includes all expenditures necessary to get that asset up and ready for use. Okay. So there are going to be other things that we're going to be considering or we're going to be talking about that are included in the cost of the purchase price in order to get that asset in place and ready to be used. So there are other things that we have to concern ourselves with. So when we look at machinery and equipment, okay, again, this is for a manufacturing facility. We are buying a new machine for our plant. There will be a purchase price for that machine, probably several hundreds of thousands of dollars. Okay. We may have to pay taxes on that machine. I don't know. It all depends on what type of asset it is. But if there are taxes that are charged to us, that's part of the price of the asset. It's not a separate charge. It's part of the cost of the machinery and equipment. Um, Machinery and equipment can be very expensive to transport from point A to point B. And again, we talked about freight charges a few weeks ago. This is definitely one you want to put on their FOB destination, because if that $500,000 piece of machinery gets damaged en route to your company, it's your responsibility, and it could be completely scrapped depending on the damage of that machinery equipment. So good advice for your accounting team when you are buying fixed assets, especially machinery and equipment, and it's being shipped to you via truck or rail or whatever, could be boat, who knows. Make sure it is either insured before it gets to your plant, or make sure it's being shipped to you FOB shipping point. So other things that are going to be part of the cost of that machinery and equipment, again, the purchase price, the taxes, the freight, the transportation charges, installing, assembling, and testing are also going to be part of the cost of that machinery. So you have to, the machinery, a piece of machinery comes to your plant. It's sitting in your parking lot. There are going to be, I think they're called riggers, people on lift trucks that are going to basically carry that machinery from the truck to the plant. There may be a base that you have for that plant, maybe a concrete base, so you have a steady ground to put that piece of machinery on. That's part of the installation of the machinery. And then again, it has to be assembled. It may come in pieces and you have to put the thing together. Well, the time it takes you to put it together, and the parts, whatever you need in order to put it together, that's all part of the cost of the machinery and equipment. And then once it's installed and assembled and ready to be used, there might be a testing period to make sure the machine is doing what you want it to do. And that, again, that time and material can also be part of the cost of machinery and equipment. And again, insurance while in transit, that's another area that kind of goes hand in hand with transportation charges. If it is being shipped FOB shipping point, okay, if it is being shipped that way and it's your responsibility once it leaves the vendor's parking lot, make sure it is insured. So if something does happen to it, the insurance company is going to take care of the costs of the damage of that equipment. Any questions on that? Anybody have any questions? Good. Thank you, guys. Excellent. As we move forward here then, buildings, look at all the fun stuff we have if we put a building together. The cost of the purchase or construction of a building. I know I've been part of a number of building expansions or new buildings being put up. They're very they can be very complicated or very challenging, because you have a lot of people involved here. You have attorneys to make sure paperwork is legal and documents are legal, and everything is going smoothly. You most likely will have title fees, permits, building permits. You'll be charged by the city or the state. You may have accounting fees, you may have brokerage fees. If you are borrowing money, or if you are selling bonds or stock or something to put this building up, there will be brokerage fees. That's all part of the cost of the building. And then again, you have taxes. Taxes, it seems like whatever you buy or whatever you purchase is going to have tax matters related to it. But again, there's a number of different things here other than the cost of the construction of the building or putting the building up that you have to be aware of or is part of the cost of the building. Um, for example, the air conditioning unit that's going to be installed. Well, do we have to, if we, sometimes someone, people, or the furnace or the air conditioner, you may have somebody say, well, that's not part of the building. That would be a piece of equipment, so that'd be depreciated differently. However, if you put that furnace or air conditioner up, and if you would take it down, if it would alter the makeup of the building, then it's part of the building. Um, there's a lot of tricky things, airlines or electrical uh, portions of the building. Are those separate or are those part of the building? So there's a lot involved in determining what is the building and what is the cost of the building. What would be maybe considered a cost, jib cranes for the building, or cranes bringing materials to and from point A to point B. Are those part of the building, or is that a fixed asset that would be a piece of equipment? So again, your knowledge has to help you determine where these different items are going to go. Now you may ask, well, why would you care? Well, depreciation of a building is going to be a lot longer than the depreciation of a piece of machinery. So it could be a tax situation where certain things you want depreciated sooner than later to allow you for tax breaks. All right. Land improvements, parking lots, driveways, fences, walkways, and lighting systems. So again, land improvements, would this be considered the cost of land? Yes or no? I'll take, if you got a 50% chance of getting it correct. I only got 4 students tonight, so we'll see what happens here. Melissa says no. Sarah says no. Nicole says no. And Heidi says yes. All right, Heidi comes in with a yes at the end there. Actually, Heidi, this is not part of the land. And the reason it's not part of the land is because these items can be depreciated. Parking lots, they do fall apart over time. Okay. And it's kind of a trick question, Heidi. So that's why, I kind of tricked you a little bit there, but the land improvements would not be considered part of the land because these items can be depreciated. Driveways, just like your own driveway needs to be maybe redone after 10 years or whatever. Fences, they deteriorate. Walkways, lighting systems these all have useful lives, and they would be depreciated over the useful life of the improvement. So that's the difference, because if you look, land is not depreciable. You can't depreciate land. The land that your building's on, it doesn't deteriorate. Okay, it's been here for a long time, and land doesn't deteriorate whatsoever. I mean, you could take everything off of it, but it's still land. Yes. Yeah. So, and again, a piece of land, let's say you um, raise buildings off the land, get rid of them, you cut down trees, you take out rocks, it's still a piece of land. And I mean, if you're preparing this land um, to put a building on it and you have to do all of these things, that's the cost of the land, but it doesn't get depreciated. So the price of the land, the title insurance on the land, the property taxes, meaning that you may have property taxes from the prior party that are delinquent, or it's just property taxes that are part of the land that now that you're responsible to pay. Surveying fees, okay, if you're going to be doing all of these different things. And again, you have the legal fees when you're purchasing land. You have to make sure it's done correctly. And you may have a agent working on your behalf to make sure that the land is purchased, and kind of looking over the legal fees to make sure everything is all the basically the I's are dotted, T's are crossed. So there's a number of items here um, that are included in the land, and again, not included in the either in the boxes here would be buildings. If you had to get rid of buildings that are on the land and tear them down and get rid of materials, that's all the cost of the land. If you had to have somebody come in and cut trees down because you want to put a building up, and the trees are in the way, okay, you again you have to it's part of the land, it's part of the cost of the land, it's part of preparing the land to put the building up. How about let me throw maybe another trick question at you. Landscaping. Cost of landscaping, is that land or land improvement? I got two land improvements here. I got three from Nicole. All right, you guys are correct. That is part of land improvement. So yeah, and again, I know my landscaping here at my home needs improvement. So there, you always need to upkeep your landscaping. It's not cost of the land. It's a separate land improvement cost that would be depreciable. Good. I didn't get anybody on that one. You guys did a great job. Thank you. So as you can see, talking about fixed assets and what we need to depreciate, what we need to include in these fixed assets can be rather challenging. Um, so don't be surprised if you would see a multiple choice question on all of this stuff in the question, and then it's going to ask you, well, what is the cost of the building, or what is the cost of the land? And you kind of have to figure out, well, what is and what isn't. So again, it can be a little challenging if you look at it. Your slides or your textbook materials can help you out. All right, any questions on what fixed assets are and what they could cost you? Anybody have any questions? Good. Excellent. Well, let's move forward then. Be aware of the fact that there could be a situation where you're buying a piece of land, and on that land is a building, and on that building there is equipment within that building. So you're kind of buying everything at once. You're combining different assets, okay, and you're paying a lump sum for all of the assets, okay. Um, but we have to depreciate them differently because land and building and land isn't depreciated, but buildings are depreciated. And in this case, we just have land and building, but in that building could be equipment that is part of the purchase price of the building. And if that's the case, we would have three items there instead of two, but we have to know how to allocate the cost of the purchase price of that land and building in this case, and how we allocate that to our different fixed asset groups. So we've got CarMax paid $90,000 to acquire a group of items consisting of land's appraised at 40,000, and a building that's appraised at 60,000. So it looks like we're getting $100,000 worth of assets, and we're only paying 90,000 for it. Be aware of the fact that when we list these assets within our balance sheet, they're listed at what we purchased them, not at what they've been appraised for, but what we purchased them for. That's always kind of tricky for especially the first year accounting student. They may think, well, if it's appraised for 40 and 60 accordingly, wouldn't that be what we'd be recording in the books? No, it's not. It's always what we pay for that asset is what we're going to be recording it for in our accounts, in our books. So, and again, we have to determine based on that $90,000 cost, well, how much is appraised, how much is allocated to land, and how much will be allocated to the building. So it's not that difficult, a little bit of math work, but we know that the building is 60,000 and we is appraised at 60,000 and the land is appraised at 40,000. Total is 100,000. So they make it kind of nice and easy for us. So the building 60 divided by 100 is 60%, and the land 40,000 divided by 100,000 is 40%. So now we have to, now we know the cost is 90,000. 60% of that 90,000 would go to the building, and then 40% of that 90,000 would go to the land. So as you look to the far right side there, you've got that green box there. And it says Exhibit 10.4 right above it. That's going to be our journal entry. So again, 60% of 90,000, if my math is correct, 54,000 would be debited to land. And then 40% of 90,000 or 36,000 would be debited to land. I'm sorry, building would be 54,000, land would be 36,000, and we paid 90,000. So we're recording the cost of some assets that we've purchased. So that's basically how we would allocate those costs then to fixed assets that we purchased kind of in a lump sum. And then again, if we would have, let's say we had buildings there as a third item, then we would have to add the appraised value. I'm sorry, let's say we purchased machinery and equipment, or the building included machinery and equipment, we would have to find out what the appraised value of that machinery and equipment was, and then we'd have three items here and determine the percentages. Percentages always must equal 100%, but then we would have certain dollars allocated to the machinery and equipment, certain dollars to the building, and certain dollars to the land. So again, I think the hardest part here is not the math itself, but finding what the appraised values were for the items that we're purchasing. So we know what assets are. We know how to cost out assets. So we purchase assets. I know March and Schmidt every year they're buying something that needs to be capitalized. Okay, it might be a new computer system. It might be a new network, a drive. It might be hardware, computer hardware, like a new server for the company. Might be buying a new telephone system, phone system. We might be buying several new copiers for the office. And again, in our plants, we're always buying machinery and equipment to keep our products looking good quality products, need good quality machines, and buying vehicles, a number of different things that we're always purchasing that would be considered fixed assets. So we have these on the books. Well, now for book purposes, we don't want to expense that all in one period. We buy a $2 million building. We don't want to expense that $2 million in 1 year. I mean, our financial statements would look dismal. So proper accounting treatment would say that, well, we're going to be depreciating that building over the life of that building. And in order to depreciate our fixed assets, we can use, and there are other methods, but we're not going to get into those. These are the kind of the main ones. I remember one, and I don't think it's even used anymore. It was called Sum of the Year's Digits. It was a more complicated than anything else, but For book purposes, we're going to just be looking at straight line depreciation, unit of production, and declining balance depreciation. So these are the three items we're going to be looking for or looking at to determine how we're going to depreciate the fixed assets that we have on our books of entry. So depreciation then, again, a good definition here in the box above. Depreciation is the process. It's a process. It's a rational and allocated process, okay, of the cost of the plant assets, and then it's expensed using one of these methods, okay? So again, when we purchase the fixed asset, the cost of that asset, talked about that earlier, is placed in our balance sheet. And again, not the fair market value of those assets, not the appraised value of the assets. What we pay for those assets are what we see and are put in our balance sheet. So then over the life of the asset, we're going to allocate the cost of that asset as an expense in our income statement. So when we buy the assets, the land, no, excuse me, not the land, excuse me, the land improvements, the machinery and equipment, vehicles, um, um, the building, whatever, those are placed in the balance sheet. Okay, those are fixed assets. However, as those are being expensed, the depreciation then, and we talked about this earlier in the semester, that depreciation expense is part of the income statement. So we allocate dollars on a year by year basis from the balance sheet to the income statement. So let me ask you this, and you should know it because we've done it before. If we're going to debit depreciation expense, what are we going to credit in this case? What was that journal entry we learned a few weeks ago? And I know there's only 4 students here, so I'm kind of picking on you guys a little bit. If you don't know, I can always I'll give you a little more time here, but if you don't know, I can always I'll spill the beans. Oh, okay. No problem, Sarah. Ah, thank you, Nicole. You got it. Accumulated, well, accumulate lead. It's accumulated. Yeah, that, okay. Accumulated depreciation. Yes, that's what we credit. And remember, accumulated depreciation is a contra asset account. It's an asset with a credit balance. Because remember what we learned, assets have a normal debit side balance, but accumulated depreciation, just like allowance for doubtful accounts, we talked about that last week. That was a contra asset account, credit balance. Same with accumulated depreciation. It is a credit balanced, it's an asset with a credit balance. So yes, the income statement is going to show the depreciation expense, and then we're going to credit that accumulated depreciation account over the life of the asset. So that is a more meaningful way of expensing something rather than expenses being incurred all in one year. I mean, that's just not the proper accounting treatment. So when we're determining how to compute the depreciation for a fixed asset, there are 3 things we need to know. So when we look at an asset, we need to know the cost of that asset. Again, we talked about that. And, we've been talking about that since we started here this evening. What is the cost of the asset? So once we have that, the next question we have to ask ourselves, ironically, is, well, when we're going to sell that asset at the end of its useful life, is there going to be any salvage value? Can we get any money back, or can we sell it, or can we scrap it or whatever and get something back, something of value back? It's usually a dollar value. So salvage value usually, let's say we're going to buy a $50,000 car for our company that is going to have a useful life of 5 years. Well, at the end of 5 years, we've taken good care of our vehicles. Perhaps we can get $10,000 for that vehicle. That would be the salvage value. Okay. Any questions on what salvage value is? Because it's going to affect our depreciation. So I want to make sure you guys know what salvage value is. Good. Thank you, Sarah. She's on the bus. Thank you, Heidi. Nicole, smiley face. Good, good, good. Thank you, Melissa. Excellent. So the cost is something that we need to be aware of. We need to know what to calculate to get the cost. The salvage value, we need to have something there to determine what is going to be the salvage value once once we're done with that asset. And again, the third item would be useful life. How long is this asset going to last within our company? Now, usually companies will have their, I don't want, I'm going to say benchmarks. So they're going to say, well, computer systems, those are going to last, those are going to have useful life of 3 years, as well as computer software, hardware. Machines in our plant will have a useful life of 10 years. Vehicles we buy will have a useful life of 5 years. And buildings we put up will have a useful life of 20 years. So usually a benchmark that they have, or that your outside accounting people will allow you as far as how to determine the depreciation value of these class of assets. I know at March and Schmidt we have classes for furniture and fixtures, classes for computerized software and hardware, different class for vehicles that we buy, machinery that's purchased, office equipment. So they all have their separate useful life categories. But be aware of the fact that for classroom purposes, we will have, they will tell us what the useful life is going to be. So we will know what that is. Okay. So again, those depreciation methods that we're going to be talking about then is, well, the first one is the straight line method. Okay. And that's the easiest one to learn. Okay. Not too much involved there. The second one is going to be the units of production method. Okay. We'll see what's involved there. And then the third one is the double declining balance method. Double declining balance is probably going to be the more challenging. Again, straight line, there has been criticisms out there as far as standard generally accepted accounting principles. Is straight line the proper depreciation method for our fixed assets? Is that going to give us a true picture of the book value of our assets? Or are we going to get a better indication using units of production or double declining balance? What is the best method for us? A lot of companies use straight line because it's the easiest one to use. I mean, when you've got a larger company that has maybe hundreds or thousands of assets that it needs to record depreciation for, straight line is, I guarantee a straight line would be the best one to use because you can accumulate those in different classes and then use straight line to determine the useful lives. So can get rather tricky there, rather complicated or complex, but we won't go there. I just to kind of let you know that. So when we talk about straight line, it's basically what is the cost of that asset, then you subtract the cost, you subtract the salvage value then from the cost of that asset, and just basically divide it by the useful life of the asset. So if we're buying an asset for $10,000, and in 5 years we're going to sell that asset for $1,000, so the salvage value would be 1,000, and it's going to last us 5 years. We know that we can take 10,000 minus 1,000 is 9,000 divided by 5 years, and if my math is correct, we can depreciate that piece of equipment on an annual basis for $1,800 per year. And there you, as of December 31st of the first year, you can see that we're going to be debiting depreciation expense for $1,800, crediting accumulated depreciation machinery for $1,800. So with that being said, you're going to see this journal entry for for not only this year, but the next 4 years. And then after that, we are going to dispose of that machinery, and we'll talk about that journal entry a little bit later in the lecture. But again, it's fairly straightforward here. Salvage value is the easiest method to use, and why so many companies use it, because it's not that difficult to compute depreciation using this method. All right. Any questions on that? Good. Excellent. All good. All right. Thank you, everybody. Looking good there. So if you look then, this kind of a framework as to when we depreciate, we're depreciating 1,800 per year. So the first year depreciation, so we buy it in beginning of 2021, depreciate 1,800 in 21, 22, 2023, 2024, and finally the last depreciation on that machine would be 1,800 in 2025. So that's how depreciation is going to look. It's a straight number for the next 5 years. The book value of that piece of machinery is going to start falling from 10,000 the first year to 8,200 the second year to 6,400 the third year to 4,600 the fourth year to the fifth year 2,800, and then finally getting to that $1,000, which would be the salvage value in 2025. Now remember that that piece of machinery, the cost of that machinery doesn't change um, for any of the 5 years. It stays at $10,000. What's what's changing on a year-by-year basis is the accumulated depreciation. So at the end of 2020, as you can see in the boxes at the bottom, the book value of that machine is not 10,000, but is now 8,200. So that piece of machinery on a year-by-year basis will always be at $10,000, but the accumulated depreciation is going to build up to determine the book value of that machinery at the end of each year. So if I take at the end of 2022, the book value, the machinery is at 10,000. There's $3,600 worth of accumulated depreciation. So now the machinery less accumulated depreciation would be the book value of $6,400. So a lot of students think, well, we're just going to reduce the price of machinery and not use accumulated depreciation, but that's not the case. That's not how it works. We always use that contra asset account to reduce the book value of the piece of equipment. That piece of equipment always stays on your books at what we paid for it. Does that make sense to everybody? I know in the accounting world, we always have to make things so darn confusing. Good, good. So proper accounting treatment would be not to reduce the value of the machine, but to increase the value of accumulated depreciation to determine the actual book value of the machine after each given year. And a great way to look at that is via a table. So again, we buy that piece of machinery at $10,000 in 2020. We depreciate it then at $1,800 for the first year. Accumulated depreciation is $1,800. The book value drops to $8,200. Second year, accumulated depreciation increases to $3,600. Book value decreases to $6,400. Again, third year, accumulated depreciation increases to $5,400. The book value decreases to $4,600. In 2024, that accumulated depreciation increases to 7,200. The book value drops to 2,800. And finally, in 2025, accumulated depreciation climbs to 9,000 and the book value is 1,000. Well, why do we have $1,000 left at the end of the useful life of the piece of equipment? Anybody know? Shouldn't that be zero? Why would we have $1,000 left? Oh, thank you, Melissa. Yes. Yeah, no, that's right. You're correct. That's basically what the salvage value is. So we sell that piece of machinery for $1,000, and that basically is the same is the amount left of the accumulated depreciation for the piece of machinery. So yes, that $1,000 is basically the salvage value. So in order to clean out our accounts, once we sell it for $1,000, we can reduce reduce the accumulated depreciation at that point and clean the machine out. Take out the machine, take out the accumulated depreciation, everything is gone because we don't have the machine anymore. Good, thank you. All right. Let's just briefly talk about units of production. We'll get back into this after our first break here at 7 o'clock. But we're going to talk about the units of production method. And if you are part of a manufacturing operation, this is probably more of a system that you would want to use than if you were a service organization. Although I would imagine, depending on what a unit is within your company, if you can define a unit, you can use units of production as a method to depreciate your fixed assets. So again, that cost minus salvage value is basically the numerator there, just like for in straight line, cost less salvage value divided by the units of production. Okay, so that is going to determine what our depreciation expense is per unit. And then our depreciation expense is going to be our depreciation per unit times the number of units produced in that given period. That will determine what our depreciation expense is. It's more of a accurate picture of what depreciation should be, because the more units we produce in a given year, the more that machine is going to be depreciated. So that's kind of why I like this. If you can use it, if you can define what a unit is within your company, it's not a bad system to use. It's probably a more accurate system to determine the value of your assets. But it is 7 o'clock. We will continue with units of production. I think we do have some numbers we can work with there. We'll hit that at the start of the second period, second hour of the lecture. Let's come back at about 7:10 and we'll go from there. So we'll see you at 7:10. Okay, is everybody set to go? I got one. Thank you, Nicole. Nice smiley face. Sarah and Heidi, are you guys all set? Oh, good, good. Excellent. Thank you, everybody. Um, again, uh, I'm going to apologize in advance for the dogs barking, but I'm sure, I think my wife will be coming home shortly and they will bark when she comes through the door. So my apologies ahead of time because you probably won't be able to hear me when I apologize the second time. All right. Again, we're using units of production as our depreciation method. There is the two-step method for calculating depreciation. Again, we need our depreciation per unit, cost less salvage value divided by total units of production for that fixed asset. Then we get our depreciation per unit, and then the number of units produced in the given period times that per unit depreciation will give us our depreciation expense for the year. Okay, so again, we get the cost of our, must be a machine or a shoe machine equipment. Okay, we know what that is now. That's costing us $10,000, salvage value of 1,000. So the depreciable cost is 9,000. It's going to last 5 years, and the number of shoes we're going to be producing on this machine is 36,000 shoes. So the unit in this case is the shoes as the units of production. Okay, so we're going to do $7,000 in the, or excuse me, not $7,000, 7,000 units or 7,000 shoes in the first year in having this piece of fixed asset. So in that case, now we can put some numbers to our formula. $9,000 divided by 36,000 total shoes to be produced on this machine. And doing our math here, that would be 25 cents per shoe. We will be doing 7,000 shoes in the first year. Simply multiply that 7,000 units by 25 cents, and our first year depreciation is $1,750. A little more math involved than the straight line, but I think it makes more sense to use this type of method of depreciation, although it's not used that often. But I think it's something that we need to take into consideration as far as finding the accurate value of our fixed assets. Again, book value can be tainted a little bit when we use straight line, but in this case, the more we use this machine, the more depreciation is going to be charged on the machine. So I feel that this is a more accurate method than straight line, but straight line is an easier method to use. So then as far as units of production, it kind of shows us in years 21, 22, 23, 24, and 25, how many units are going to be produced on this machine. So as you can see in the third year, 2023, is the year when we're going to be manufacturing the most shoes, 9,000 shoes. And again, that 25 cents is going to be the rate for all 4 or 5 years there, all 5 years, to determine what our depreciation is going to be. So our depreciation expense is going to be based on how much usage we have for this machine. So on the last year that we have the machine is going to be, and most often the case is you use the machine most often in the earlier life of the year and then less later in the life of the machine. In this case, it kind of worked its way up per year until we got to 2023, and then it backed down to 7,024. And finally, the smallest amount, 5,000 shoes being manufactured in 2025. That's going to be where we're going to have the least amount of depreciation. And as you can see, it doesn't matter if you're using straight line depreciation or units of production depreciation, because by the time we get to that fifth year, you're always to the same area. If you remember back when we talked about straight line depreciation, our accumulated depreciation at the end of the fifth year was $9,000. It's the same thing under units of production. It's just how do we depreciate that within the 5 years of the life of the machine? And we still have the $1,000 salvage value at the end of 2025. So that will always stay the same no matter if you're using straight line or if you're using units of production. Again, you're going to get to the same destination. It's just how you get there is going to be different. Any questions on this, the units of production method of depreciation? So I want to make sure everyone's aware of what the formula is, and then how we use it to put, when we put numbers in there, how we use it to calculate our depreciation expense. Good. Double declining balance is probably the more challenging type of system. And basically what it's doing is depreciating the fixed asset more in the earlier years and less in the latter years of the life of the machine. So again, we have the same scenario. The machine costs $10,000. It's going to have $1,000 salvage value. So the depreciable cost is $9,000, 5-year life, and units inspected, 36,000 shoes. So in this case, we're going to basically, well, what's the straight line rate? 5 years. So basically, you're going to take 100 divided by 5 years, and you're going to get 20. So if 100% divided by 5 years is going to be 20% per year. Okay. Under double declining balance, though, or declining balance under double declining balance, we're going to multiply that 20% times 2 to give us 40%. So that's the rate we're going to depreciate the cost of the machine. Now, only for double declining balance, this gets a little tricky, but only for double declining balance, we do not subtract salvage value. For our straight line method, we subtracted salvage value to determine our depreciable cost. And for units of production, we did the same thing. However, for determining the double declining balance depreciation, we do not subtract salvage value from the cost of the machine. So we're going to take 40%, again, that 20% times 2 times $10,000, or we know that for the first year, that machine's going to depreciate by $4,000. So at the end of the first year, the book value, what would be the book value of the machine at the end of the first year then? Can somebody give me an answer? What would be the book value of that machine at the end of the first year using double declining balance for depreciation? Thank you, Heidi. You got it. 6,000. We depreciated at 4,000. Thank you, Sarah. You are correct. 6,000. Yep. Oh, there you go. Okay, we found it. We put the extra zero there, Sarah. Thank you. So again, 6,000. And then what do we do for the second year? What do we multiply that 40% by? Do we multiply it by the 10,000 again? What do we multiply it? So now we're into the second year. We want to do the second year's double declining depreciation. What do we multiply that 40% with? Oh, by the 6,000. Thank you, Heidi. Yeah, 6,000 times the 40% would equal what? $2,400. So here is the schedule. So again, the first year, 10,000 times 40% is $4,000. So again, the book value of that machine goes from 10,000 to 6,000 times 40% is 2,400. So now we're depreciating it the second year by $2,400. So our cumulative depreciation goes up to 6,400, and our book value at the end of year 2 is $3,600. Multiply that by 40%, and we get 1,440. So now our cumulative depreciation is 7,840, and our book value is 2,160. Multiply the 2,160 by 40%, we get 864. So the accumulated depreciation climbs to 8,704, and the book value depreciates to 1,296. So for purposes, I think if you take 1,296 times 40%, I think you get 296, or maybe that's just basically we have to, all that we have left to depreciate it in the 5th year. I think that would be, I think 1,296 times 40% would be more than 296, but that's all we have left to depreciate. So to get to our $1,000, so again, under double declining balance, we don't use the salvage value in our calculation for our annual depreciation. But as you can see, we got to the same destination that we did with straight line and units of production. Accumulated depreciation's at 9,000 at the end of 5 years, and that book value is $1,000. So that doesn't change no matter what method we use. It's just how we depreciate it for the 5 years of its useful life. And as you can see, using double declining balance, we're depreciating it more in the early stages of the asset than the latter stages of the asset, because that machine should be doing more for us when it's younger than when it's older. Any questions on double declining balance? Good. Excellent. Thank you, guys. Looking good. Hopefully everyone's still on the bus. So let's look at the 3 methods and put them side by side with one another. As you can see, straight line is just that straight amount. Every year, $1,800 gets us to 9,000. Units of production is basically based on how many units are produced in any given year. And if you remember correctly, I think we produced the most in 2023, and that's when we had most depreciation, and then it fell off from there. But as you can see, by the end of 2025, we had the same number that we did for straight line, 9,000 of accumulated depreciation. Double declining balance then was depreciated more in the first 3 years, and then it just kind of fell to 0 by the time we got to 2025 with accumulated depreciation of $9,000. So no matter what we'd use or no matter what we do, we're always going to get to that $9,000. It just depends how we want to value our book value of our fixed assets. What method do we want to use? So let me ask you guys this. We'll get a little tricky with this. At the end of 2021, just looking at the 3 depreciation methods, what method is going to give us a larger bottom line net income? Oh, you guys, excellent. Excellent, Heidi and Sarah. You are correct. Yes, thank you, Melissa. Thank you, Nicole. You guys are correct, because units of production is the less amount of depreciation, and the less amount of depreciation expense for that given year is going to give us a larger net income. However, double declining balance, we're going to take our lumps in the earlier years and as far as what our net income is going to be, so that $4,000 of depreciation expense is going to give us a lower net income based on the other 2 depreciation methods. But then when we get to 2025, we only have 296 left to depreciate. So by that time, you're going to have a higher net income value than the other two methods. So again, could be strategy for your reasoning and picking and choosing the depreciation method that that you'd want to use um, based on what your net income would be at the end of the year. So there are a number of different reasons why companies would use straight line, a number of reasons why companies would want to use unit of production, and a number of reasons why companies would want to use double declining balance. However, if you look at our pie chart at the bottom, um, you can see that again, straight line is most often used by companies. Very few companies, 5% of the companies they probably surveyed here, use units of production. Double declining balance was 6%, not much larger. And then other methods was 4%. So 85% of companies use straight line method. March and Schmidt use a straight line method. Does anybody know what depreciation method you guys use for your company? Anybody know? Just curious. Okay, good. Um, but again, straight line, and the reason 85% of companies use straight line is because um, it's easy to use. And that's why they use it for book purposes. This where it gets a little complicated because the government uses a system called modified accelerated cost recovery system. That's what they call it, or makers. Modified accelerated cost recovery system. This is not acceptable for financial reporting purposes, but it is used for tax reporting purposes. Um, be aware of the fact this modified accelerated cost recovery system does not take into account the useful life of an asset or the salvage value. So that's why it's not used for financial reporting purposes. All companies that are out there have a depreciation method that they use for book purposes, for financial reporting purposes, and they have a depreciation system that they use for tax purposes. For the most part, companies want to depreciate as much as possible the first year of the life of the asset. And why do they want to do that? Well, again, just kind of like what we talked about in the prior slide, for tax, excuse me, for tax purposes, you want to have the least amount of income as possible to pay less taxes. So if you use a modified accelerated cost recovery system, it's going to treat your fixed assets, you're going to depreciate them very similar to that double declining balance. They're very similar methods, meaning that you're going to depreciate more in the beginning stages and less at the ending stages. But what the government says is, we will let you depreciate more in the earlier years for your fixed assets, but it's going to come back to haunt you unless you buy more equipment. So if you continue to buy more and more and more fixed assets on a year by year by year by year basis, that's never going to catch up, and you're always going to have more and more depreciation for tax purposes. If you stop buying, that's where it's going to start to hurt you. But if you continue buying, you're always going to be ahead of the game. You're always going to be able to defer taxes to a later year based on the depreciation method that you're using. So that's why the government allows you to use this type of system. Because for one thing, they're saying, okay, well, you pay less taxes to Uncle Sam, but yet you're helping the economy out by buying more machinery and equipment. As a matter of fact, and I don't want to get too complicated with this, but I think in the past several years, the past several presidents, they allowed a like 80% or 100% deductible tax deduction for fixed assets in the first year. So they were not only using a modified system, but they were saying if you buy a machine for $2 million, 80% of that can be depreciated for tax purposes the first year because they're trying to get the economy going and they're taking less tax money from the business person. But again, if you don't buy machinery, that's going to come back to haunt you in the latter years when you're not buying, because now your book depreciation expense is going to be greater than your tax depreciation expense. And then you're going to be paying more taxes. So just kind of a picture that, and I'm sure all your companies use this strategy, trying to buy fixed assets to save cash and to save on paying less income taxes. So that's, your companies know this, and the accounting people that work with your companies know this. So it's something that's used very seldom. Okay. Any questions on this, on tax depreciation versus book depreciation? Good. And again, if you have to take, I don't know if you guys have to take more accounting, if you have to take intermediate accounting for your degree, but you get more into this when you get there. So I'm just going to kind of get your feet wet tonight on it, but that's all that I'm going to look at it. That's all we're going to talk about here. All right. Any questions then on depreciation expense, the methods used, or the calculations? Anybody have any questions so far? Or is everybody on that bus? Thank you, Sarah. Melissa, thank you. Heidi, thank you. Okay, thank you. Everyone's on the bus. Good, Nicole. She's smiling away there. Good. Because we're going to go now, and we all know that when we buy fixed assets, we don't, on January 1st, go out and buy fixed assets. So it's depreciated for that full year. We buy fixed assets on any given month of any given year. So depreciation, if that's the case, depreciation is going to be a partial depreciation expense for the first year and a partial depreciation expense for the last year. Because if you buy, let's say you're going to buy fixed assets on July 1st, 2024, in that case, you're buying the fixed asset and you're only going to have 6 months depreciation this year. And then if that piece of machinery is going to last 5 years, by the end of the 5th year, you're going to have 6 months of depreciation in that last year. Every other year, you'll have a full years of depreciation. So in that case, let's look at a scenario here. So a plant asset is purchased. During the year, depreciation is calculated by the fraction of the year the asset is owned. So the cost of the asset's 10,000. The salvage value is 1,000. So we'll use straight line for this case here. Makes it easier. So our depreciable cost of that fixed asset's $9,000. Again, 5-year useful life. And again, the units inspected is 3,600 or 36,000 units. So now let's say we're going to buy that machine on October 1st, 2020. So depreciation for expense for 2020 is going to be 3 months of the year rather than 12 months of the year. So we're going to take that 9,000, 10,000 minus 1,000 divided by 5 years times 3 divided by 12, and we're going to see instead of $1,800 for the first year depreciation, we're only going to have 3 months of depreciation, or $450. So that's going to be our depreciation for the first year, 2020. Now for the latter years, 21, 22, 23, and 24 are going to be the same $1,800, but then that last year then is going to be the 9-month period, or 3/4 of that 1,800, or whatever that would be at the end of the 4th year. I thought maybe they would show it here, but I guess they didn't. But again, it's going to be 3/4 of that 1,800 for the last year. I think my wife is coming home, if I would guess here, because all the dogs are barking. Okay, and this is a great time when everything's going wild and everyone's barking. And my favorite type of ice cream is Rocky Road. So that's my favorite type of ice cream. So we'll see if the discussion, we'll see if the who watches the recording can hear that over the barking dogs. All right, so let's continue forward. Partial year depreciation. So again, um, 1/3 or 1/4 of that depreciation is the first year, and then 3/4 in the last year of the life of that asset. Any questions on that? Good, good, excellent. Thank you, guys. All right. Also be aware of the fact that depreciation, we can change the method that we're going to use. Or we find that we're using the same method, but that our estimates are inaccurate. New information may come to light to determine that the depreciation estimate that we calculated was an inaccurate number. And in that case, we have to basically go back to the first year of operation and change the numbers to catch up to where we are on the current year. So let's look at let's look at a situation here, or a number here. So we're going to look at our machinery from the previous example and assume that at the beginning of the asset's 3rd year, its book value is 6,400. Okay. So that was the 10,000 cost less 3,600 of accumulated depreciation for the first 2 years of the asset. So now at the 3rd year, at this time, it is determined that the machine will have a remaining useful life of 4 years instead of 5. So a little bit more of a challenge here, and the salvage value is not going to be 1,000 anymore. It's going to be 400. So instead of having a useful life of 5 years, oh, wait a minute, at the time, it's determined the machine will have a remaining useful life of 4 years. So after 2 years of depreciating this machine, I think it's going to last 1 more year. I think that's what they're saying, because we're going to have 4 instead of 3 years left. We're going to have now an additional year, or 4 years left to use this machine. The only difference is the salvage value is going to go from 1,000 to 400. So at the end of 2 years, we're going to have 4 years now instead of 3 years left. So we take the 6,400, the book value, less the salvage value of 400. It's going to equal 6,000 divided by the revised remaining life of 4 years, or 1,500 per year in this case. So again, our numbers change, and this can happen. We find that the useful life of the machine that we are depreciating is going to last longer than expected. The salvage value may be less once we're done with the machine. So we kind of have to change the numbers and figure out what our new depreciation is going to be for the remainder of the 4 years. Any questions on that? Again, a little bit of number crunching, but just look at what they're looking for and determine what that new depreciation expense is going to be. Anybody have any questions? Good. Excellent. Thank you, guys. Looking good. And again, one of the issues that we may have when we're determining the cost of an asset is, do we expense it as incurred, or do we capitalize it as a fixed asset? So in my previous example, I want to buy a $300 light fixture for my office, okay? Now, that light fixture is going to last at least 4 years, but I'm buying a $300 fixture. Do I capitalize that as a fixed asset, or do I just expense the $300 in the year that I buy it? So that's kind of where we're going to go with now to distinguish between what a revenue expenditure is and what a capital expenditure is. So we can kind of get a little bit of an idea what a revenue expenditure is looking at the bullet points here, and then what a capital expenditure is looking at the bottom bullet points in this big red box. So a revenue expenditure, or if something that we're going to buy that's going to be expensed all in one period, it does not materially increase the plant's assets, life, or capabilities, okay? It's recorded as an expense in the current period and then reported on the income statement. So let's say, for example, I am going to buy, I'm trying to think of something. Let's say I have a machine out in my shop and I'm going to buy a new tray for the machine. Machine has a tray that you put stuff in, and I wanted to buy a new tray for it. It's going to cost me $300. Machine's let's say the machine's a $200,000 machine. I'm going to buy a $200 tray because the other tray is all beat up, and I thought I better buy a new one so I have something new to use in front of me. That is not going to increase the life of that asset. It's fairly inexpensive. So in this case, that is going to be expensed as incurred. So that $300 is going to be it's not going to be depreciated. It's going to be all expensed in one period. So now if we look at the bottom part, the capital expenditure, what would be required in order to depreciate something that I am that I'm spending maybe for a piece of machinery that I already have in my shop? Maybe it provides a longer life for the current period. It's recorded as an addition in the asset account, and then it's reported on the balance sheet. So in this example, let's say instead of buying a $200, $300 tray, I'm buying a new motor for my machine. Okay, the old motor on this machine is not going to last much longer. It's going to die out on me, so I need a new motor for my machine. So it's a $200,000 machine. That motor is going to cost $50,000, and if I buy that motor to that machine, I can use this machine for another 2 or 3 years. It's going to extend the life of the asset by buying the new motor. In this case, it's not going to be a revenue expenditure. We're not going to expense all $50,000 of that motor in the first year. Now, if it's going to extend the life of that machine, we can depreciate the $50,000. We can capitalize it as a fixed asset in our balance sheet, and we can depreciate that $50,000 maybe on a 3 or 4 year basis rather than expensing it all in the current year or current period. So does everybody see what the difference is between a revenue expenditure and a capital expenditure? Because I guarantee you the IRS is going to want to look at your expenditures and try and find as much as they can to capitalize, okay? Because if they can if you find, let's say for example, that motor that I was going to buy, let's say I'm going to be a little tricky and I'm going to expense it all in the first year. What's that going to do to my income? Is it going to increase my income or lower? Thank you, Heidi. It's going to lower it. So if I lower my income, I'm going to pay less income taxes. However, if I buy that piece of that motor and depreciate it, instead of expensing $50,000 that first year, I'm only expensing maybe $15,000. So that's going to make my income higher. A higher income is going to be more income taxes to the government. So the IRS, when they audit your books, they're going to see, well, what did you put in that revenue expenditure that should be capitalized in your fixed assets? Because the government's going to want to see is going to want to see you have a higher net income, because they're going to want to get more taxes out of you. And I will state that if they find a loophole and find that you should have paid more taxes 3 years ago than you are today, they're not only going to get the increase in taxes they should have gotten from you, but you're also going to pay interest and penalty fees on that as well. So it's a very, what I'm trying to get at is this is a very important part of determining what should be expensed as incurred in the current period, or what should be added and depreciated over the life of the asset. It's important that you understand the difference between one and the other, and your accounting people that you where you work should understand this as well, because if an audit, does anybody know if they ever get audited? If they have, does anybody know? And it's a yes, no question. If your company has ever been audited by the IRS or the state of Wisconsin? Melissa says yes. Okay. Sarah says yes. And I don't know, Heidi. Heidi may be thinking. I'm not sure. But anyways, oh, okay, we're a financial, so we're always audited. Okay. Okay, yeah, you probably are audited by your outside CPA firm, an independent firm. Uh, but yes, or regulators, yes. Yes, okay, I'm sorry, yes. Bank regulators probably audit your books as well. And they probably um, send their information to the IRS agency, but those regulators would be an independent um, governmental, I think they're governmental administration. Bank regulators? I'm going to say they are. Okay, good. Thank you. Yes. So they're kind of like a separate version of the Internal Revenue Service. But again, just like Heidi, Sarah, and Melissa know that they've been their companies have been audited, so they have to take, and I'm sure those auditors come in and look at this information, because again, they're trying to figure out if they can get more income out of you to get more taxes for them. And they're not coming there for nothing. They're coming there to find more money. And here's your kind of your cheat sheet to determine whether it's a ordinary expense or a capitalized expense. The type of expenditure, if it's an ordinary repair, let's say annual maintenance on your machines are going to be expensed as incurred. Those won't be capitalized. Um, if Again, if it maintains the normal operating conditions, it doesn't increase productivity in any way, and it doesn't extend the life of the asset, those three items in blue there are perfect examples of something that should be expensed as incurred. However, if you look at the bottom one then, betterments and extraordinary repairs, this is something, if you have an overhaul of a machine, you have the same machine, but it's being overhauled or modified or updated. We do that with a lot of our products that we sell to our customers. Maybe we sold a piece of machinery to a customer 4 years ago, and now we have a modified version of that, and we can take their old machine and modify it, and they're going to have to take the cost of those modifications and um, add that to the life of the machine, and then determine the new depreciation value of that machine. So in that case, that follows the purple print. It is a betterment of that machine, or it's an extraordinary repair. It's a major overhaul or a replacement. It extends the life of the machine. So that's going to be part of that, capitalizing that asset, depreciating that asset on an annual basis. Yes, you can get guidance by the IRS, Heidi. However, if you have your own policy and stick to it, the IRS will allow that as well. I mean, as long as you're consistent with your policy. Now, for March and Schmidt, if we purchase something greater than $2,500, we have to determine if that's going to be a capital asset or a revenue asset or a revenue expenditure. Most often, if let's say we're buying a new computer system for one of the offices, okay, and that's going to be a $3,000 computer system, that's going to be capitalized because it exceeds our $2,500 benchmark. If we are consistent with that policy, the IRS will accept it. Good question, though, Heidi. Thank you. That was a good question. Yes. All right. um, so again, for ordinary repairs, it's expense as incurred. Repairs expense, right to the income statement. Cash paid for it, again, paid debit, crediting cash. For a betterment or improvement, um, it's debited to the asset account and then credited for cash. And again, in this case, they kind of trick us up a little bit with this slide because the ordinary repairs is a lot more than the betterment or the improvement. Again, they're trying to tell us, even though the dollar amount is more under the ordinary repairs, it's still considered an expense for the period. So dollar amount really doesn't have a guideline with what we're talking about here. So if I go back to the previous slide, it says nothing about it has to be a certain dollar amount. Doesn't say that anywhere within the identifying characteristics. And with that being said, then a $9,500 item, if it's an ordinary repair that we do on an annual basis, it's expensed. And as far as that betterment or improvement, if that $1,800 is going to extend the life of that asset, it's an asset. So again, follow the rules that we have right here. So again, I'm going to go back to my example, my $2,500 benchmark. And Heidi, I'm going to kind of give this one to you. If that 20, if we spend $3,000 to repair a computer that's only going to last one more year, then we're not going to capitalize that. We're going to have to expense it. But if we buy a whole new computer system that's going to last 3 years for $3,000, then we can capitalize it. So it gets a little tricky. We just have to follow our guidelines here in the slide. So again, if we're going to improve that computer and spend $3,000, but that computer is only going to last 1 year, we follow the ordinary repairs or the blueprint. However, if we're buying a whole new computer system for $3,000 that's going to last 3 years, we follow the purple and declare it as a fixed asset. Any questions on that? I want to make sure you guys are comfortable with that ruling because it could come back to bite you in real life. It came back to bite me, and it can. And your companies are no different than what this was a previous life though. This was a company I worked with probably about 20 some years ago. Good. Thank you, everybody. Thank you. Excellent. All right. So let's talk about then. Oh, I'm at a bad spot here, but we'll start into this a little bit. Let's say we're going to dispose of an asset. Okay. So we have an asset. We've been using it for a while. Don't need to use it anymore, so we're going to get rid of it. How do we account for that? Okay. we have a kind of like a flow chart here to help us out. So if we're going to dispose of a plant asset, the first thing we always have to do, and we'll have a number of examples to help us out here. The first thing we always have to do is update our depreciation at the date of disposal. So if we depreciating something and it takes 6 more months and we're going to dispose of it, we have to update our depreciation to that 6-month period. That's the first thing we have to do. And the reason we have to do it is because we have to determine the book value of that piece of machinery at the date of disposal. We can't do that unless we update our depreciation of that piece of machinery. So then we're going to dispose the piece of machinery, and if we're going to sell it, we're going to get cash for that. So we're going to debit the cash received, okay? Or again, if we're paying money out to get rid of the machine, we're going to credit cash. We have to remove the accumulated depreciation of that asset. So that $10,000 machine, at the end of 5 years, if we're going to dispose of it, I think there's $9,000 in accumulated depreciation, which is a credit balance. If we're going to dispose of that machine, we have to debit accumulated depreciation to wash that $9,000 out of that account. We also have to credit the asset. So that $10,000 asset that we bought, we debited machinery. So at the end of the useful life, we have to credit the $10,000. I mean, we don't have the machine anymore. We have to get rid of it. We have to take care of the accumulated depreciation, and we also have to take care of the cost of the asset. And then finally, we have to look to see, well, we're getting so much for the machine that it has a book value of so much that we're taking out of our balance sheet at the cost of the machine. Is there anything left after that? If there is, we have a gain on the sale of that machine. So again, in our example, if we had $1,000 salvage value for that machine, but let's say we can get $1,500 for that machine. So now we have an extra $500 that we can get for that machine. That's going to be a gain of $500. Let's say on the other hand, we have that machine. We're going to sell that machine now. We're going to dispose of it. But instead of getting $1,000 salvage value for that machine, we can only get 500. Well, now we're going the other way. And if we're only getting 500, we're losing the other 500. So we're going to get a loss on that machine. So again, gains and losses we have to determine in order to determine the proper disposal of that machine from the books of our assets, from our assets in our balance sheet. And I'm just going to hit this blue box, and then I'll take our second break. So if cash is greater than the book value, record a gain, a credit. A gain is a credit in our income statement. If the cash is less than book value, record a loss or a debit. If cash equals book value, no gain or loss whatsoever. So I'm going to hit you with that. Let's take our break. We'll come back at 8:10, and we'll continue with our lecture and finish up We'll finish up on plant assets, natural resource, and intangible assets. So we'll see you in about 10 minutes. All right, is everyone all set to go for the final hour here? I like that smiley face, Nicole. Good job. All right. All right, good. I got everybody back. Um, if you want, I would probably want to keep slide 35 in front of me because that's kind of what is going to help us put together our journal entries. So it might be just a slide you might want to set aside as we go. We got a number of journal entries that we're going to go through right now. And that slide probably will be helpful. So let's look at, this is probably the easiest scenario first, and then we'll get to more challenging ones after that. Discounting plant asset fully depreciated. So let's look at our example. Machine costing 9,000 with accumulated depreciation of 9,000. Okay, on December 31st of the previous year was discarded on June 5th of the current year. So the company is depreciating the equipment using straight line method over 8 years with zero salvage value. So again, basically what we have to do is wash out the accumulated depreciation machinery. Remember what we said, accumulated depreciation was an asset normal credit balance. In order to wash it out, we have to debit accumulated depreciation machinery for $9,000 and then credit the machinery for $9,000. So basically when we bought the machine 8 years ago, we debited machinery, credited cash if we paid cash for it. Now we're washing out accumulated depreciation of 9,000 and we're washing out the machinery of 9,000. We don't have the machinery anymore, therefore we have to wash it out. Get rid of it. It's not part of our books anymore. Everybody okay with that journal entry? It's probably the easiest one we're going to see tonight. Good. Excellent. Thank you, guys. Okay. I should say thank you, ladies, because I don't have any guys in class, and I got 4 ladies here, so I should say thank you, ladies. All right. So let's do a journal entry then. We've got the box in front of us. Let's make it a little more challenging. Equipment costing $8,000 with accumulated depreciation of 6,000 on December 31st of the previous year was discarded on 7/1 of the current year. The company is using straight line depreciation over 8 years with zero salvage value. Well, if we go back to slide 35, the first thing then is to update depreciation at the date of disposal. So we got 6 months of depreciation we have to account for. Well, if we have an $8,000 machine with no salvage value but 8 years useful life, they made it kind of easy for us. That's $1,000 per year. So we're discarding it on July 1st. So we got 6 months of depreciation to catch up on. So that 1,000 divided by 2 is $500 or $500 of depreciation expense needs to be recorded to bring the depreciation expense up to our July 1st date. So we're going to debit depreciation expense, credit accumulated depreciation equipment for $500. Okay. So if you look as of 12/31, depreciation expense was at 6,000, but as of 7/1, where's our depreciation expense? Where's our accumulated depreciation as of July 1st of the next year or of the current year? We know that as of 12/31, it's at $6,000. As of 7/1 of the next year, what is in our accumulated depreciation account? Oh, thank you, Heidi. Yes. Thank you, Melissa. You doing a great job. Yes, thank you. Thank you, ladies. Okay. Yes. $500 depreciation expense. So now our accumulated depreciation, we're going to debit 6,500 to wash that out. The equipment was $8,000. Now we're just disposing of this. We're not getting any cash for it. Okay. So this machine had a book value of $6,500 when we got rid of it, but it's an $8,000 machine. So do we have a gain or a loss on the equipment? Yes, thank you, Heidi. You are correct. We have a $1,500 loss because we've only used $6,500 of the machine that cost us $8,000. We have to dispose of it at that $6,500 accumulated depreciation level. So we don't get to use $1,500 of that machine to bring us out to 8 years. Basically, in this case, we've only used the machine for 6.5 years instead of 8 years, and we have to get rid of it. So we're getting rid of it earlier than what we wanted to get rid of the machine. So there is a loss on the disposal of the equipment of $1,500. Let's look at another scenario here. As of March 31st, BTO sells equipment that originally cost $16,000 and has accumulated depreciation of $12,000 as of 12/31 the prior year. BTO uses straight line depreciation at $4,000 per year. So now they're selling the machine on March 31st of the next year. They're going to get $3,000 cash. So again, the first thing we have to do is update depreciation for 3 months. So let's see here. Annual depreciation is 4,000. So 3 months, we divide that by 4. So we have to debit depreciation expense on March 31st of $1,000, credit accumulated depreciation equipment of $1,000. So, okay, we do that. So our accumulated depreciation is up to where it should be. And again, so as of March 31st, how much do we have in accumulated depreciation for this piece of equipment? Good. Thank you, Heidi. Melissa, thank you. Yes. Thank you, Sarah. 13,000. Yeah, okay, there you go. Okay. Yes, 13,000. Yep. Good. Excellent. Excellent. So in that case, now we have to wash out the accumulated depreciation. We have to wash out the equipment. And now in this case, we're getting $3,000 cash for the machine that we've used. So we can sell it for $3,000. So we're getting $3,000. We debit cash. That's an easy one. Wash out accumulated depreciation of $13,000. The equipment costs us $16,000. So do we have any gain or loss on this transaction? They're correct. We have none. There's no gain or loss because basically we disposed of a $13,000 machine that cost us $16,000, but we got $3,000 cash at the date of disposal. So 16,000 each way. There's no gain or loss. All right. Good job, everybody. So now let's look at another scenario. As of March 31st, BTO sells equipment that originally cost $16,000, has accumulated depreciation of $12,000 at December 31st of the prior year. BTO uses straight line depreciation of $4,000 per year. Equipment is sold for $7,000 in cash. So again, update depreciation. So we debit depreciation expense and credit accumulated depreciation equipment for $1,000. So our depreciation is up to date as of March 31st, 3 months into the next year. And now we're getting cash of $7,000 for this. So we can debit cash. We're getting that for the sale of the machine. We can we can debit out our accumulated depreciation of $13,000. The machine costs us $16,000. So we've got cash and accumulated depreciation totaling 20,000 for equipment that costs us 16,000. So do we have a gain or a loss on the sale of this equipment? Or are we at break even? Yeah, excellent, Heidi. Thank you. And Nicole, thank you. Thank you, Sarah. So yes, we have a gain on the disposal of the equipment for $4,000. Again, make sure your debits equal your credits. And if you have to, you can squeeze in that gain or loss. Um, if our gain is a credit, a loss would be a debit. And I think we'll see that in our next slide here. On March 31st, BTO sells equipment that costs 16,000. So same scenario, accumulated depreciation of 12,000 at December 31st. BTO uses straight line depreciation at 4,000. So now we're selling the machine for 2,500. Again, update depreciation as of March 31st, debiting depreciation expense for $1,000, crediting accumulated depreciation equipment for $1,000. So now at the date to record the sale of the asset, we're only getting $2,500 for the machine. We still have to wash out accumulated depreciation equipment, debiting 13,000. We're still crediting the equipment for 16,000. So now cash and accumulated depreciation of 15,500. The equipment cost us 16,000. Do we have a gain or a loss in this case? Thank you, Heidi. Yes, Melissa, thank you. And thank you, Sarah. Yes, you guys are correct. We have thank you, Nicole. We have a loss on the disposal of the equipment of $500. Okay. So be aware of how that transaction is going to work. And then what is left is basically, I mean, look at what you're getting for cash. Make sure you wash out the accumulated depreciation, and then make sure you wash out the piece of equipment. Do you have anything left to make to see that your debits equal your credits? Okay. If you have a credit balance left, you know it's going to be a gain. If you have a debit balance left, you know you're going to have a loss. Any questions so far on disposal of plant assets? Thank you, Sarah. Everyone on the bus. Thank you, Nicole. Or thank you. Yeah, thank you, Nicole. Thank you, Heidi. I think Melissa's out there yet. Just want to make sure everyone understands what we're doing here. All right. Thank you, Melissa. Melissa's on the bus. Good. All right. We'll continue forward then. Again, if you have any questions, just let me know. Just chime in, please. Let's talk about depletion. Depletion is not that difficult, but it's used for certain unique operations. What type of companies would use depletion, if I may ask, instead of depreciation? Anybody out there have a clue? You can give me an example if you want. Heidi, thank you. Oil. If we're drilling oil from the ground, yes, that's a natural resource. You are absolutely correct. Oil would be depleted rather than depreciated. Coal miners, I'm going to say, Nicole, yes, coal mining operations, diamond, gold mining operations, these are all natural resources. They would all use depletion rather than depreciation. Excellent. Thank you, everybody. Looking good there. So again, natural resources, we have to figure out, and again, oil, coal, and gold, we did mention those three. total cost is charged to depletion expense rather than depreciation expense over the periods benefited. Now, oil fields kind of last for quite a long time because to drain an oil field probably takes years and years and years and years. Just like coal mining operations, it's not going to take 1 week and you're done. These are going to take a while to extract the resource, okay? So again, extracting from the natural environment and reported at cost less accumulated depletion. So let's look at an example here. This is very similar to the units of production depreciation method, okay? We just have to find out it's basically a lot more difficult finding this information than actually having the information and doing the calculations. And if you would see a question like this in homework or the quiz or a final or whatever, you will have all this data. I just want you to make sure that you can do the calculations. So we have a mineral deposit with an estimated 250,000 tons of available ore is purchased for $500,000 and we expect zero salvage value. The depletion charge is $2 per ton. We'll see how they got that. If 85,000 tons are mined and sold, the depletion charge then is 170,000. So again, we have to figure out the depletion per unit. Again, we purchased it for 500,000. There's no salvage value. So that 500,000 would be the numerator. We're going to extract 250,000 tons of ore, or $2 per ton. $500,000 purchased divided by 250,000 tons is $2 per ton. So if we're extracting 85,000 tons for the first year that we mined and sold, we take the 85,000 times 2, and that tells us that our depletion expense for the first year is going to be $170,000. And accumulated depletion then for our iron ore mine or whatever it's called is going to be $170,000. Anybody have any questions as to how we did that? Again, it's following very similar rules that we did for units of production. It's just that we're extracting resources rather than determining units of production on a piece of machinery. Okay. And again, the more difficult, well, how do we know that there's 250,000 tons of ore in the mine? You know, how do we know that? It's the guess that we need to take, I guess. It always boggled my mind as to how they can figure out how many tons of iron ore are in a site for us to extract. Interesting. I'm sure we can know at the end of the first year how much we extracted, but how do we know how much is left? So there's our journal entry. Depletion expense in the first year would be depletion expense, a mineral deposit of 170,000, accumulated depletion mineral expense of 170,000. In our balance sheet then, very similar to a fixed asset, as you can see, we've got our mineral deposit. That is an asset for the company for $500,000, less accumulated depletion of 170,000 the first year. So we have 330,000 left. I like the left-hand side display better than the right-hand side display in that light orange box. I would rather prefer to see it stated in the left box rather than in the right box. I think that gives us a more common sense way of displaying it. Okay. Depletion of journal entry. So if there's depletion expense when some ore remains unsold at the year end. So we had an example where it was mined and sold all at once. In this case, though, we've mined the 85,000 tons at $2 per ton, but we've only sold 140,000 of it, and we have 30,000 left. So here we're going to debit depletion expense mineral deposit for 140,000, or iron, which is be an asset. We're going to list at 30,000. Haven't sold that yet, but actually it's an inventory item. It's part of our inventory, and accumulated depletion then a mineral deposit of 170,000. Okay. Any questions on that? Good. Excellent. Thank you, guys. Be aware of the fact, and this is kind of important, we just talked about depletion of extracting a natural resource, iron ore in our example. However, we need to have equipment to extract the natural resources. So we need to have what excavators, dumping trucks, okay, construction equipment in order to extract that natural resource. We may need some pieces of equipment to to do whatever. Maybe we need some like conveyor system. I mean, if you're anybody ever watch that what's that called, that gold mining show, can't remember what it's called, but it's on the I can't remember the name of the show now. Gold Rush. Thank you, Heidi. Yes. I don't know if any of you have ever watched that show, but the gold that they're extracting from the gold mine is depleted. It's depleting the resources. But as you can see, there's a lot of very expensive items that they use to extract that gold. They have conveyors and bulldozers and scoopers, or whatever you want to call them, dump trucks. They have a lot of different pieces of fixed equipment. They have pieces of equipment to get rid of all the non-valued waste so they can find the gold. Again, sometimes the plant assets used to extract the natural resources more than the resources themselves. So again, those assets, then those physical assets are depreciated, okay, and they're in a separate account, and they're depreciated using the units of production method in proportion to what's being depleted out of the natural resource. Because once we deplete that coal mining area or that iron ore area, we may not need this physical equipment anymore. We may want to sell it because we've extracted everything out of the mine. We don't need the equipment anymore because we're not extracting anymore. So we sell basically the equipment to somebody else. Okay, that could happen. All right, any questions on depletion of natural resources or depreciation of physical assets used to extract natural resources? It's kind of a rare area in the accounting world, but there are um, different areas that mine for coal, for oil, or not for, they don't mine oil, for diamonds or gold or iron ore or something. Um, so they use the depletion expenses to extract that natural resource. Good. All right. We'll continue forward then. So we talked about depreciation of fixed assets. We talked about depletion of natural resources. Let's talk about something called intangible assets. So what would be your definition of an intangible asset? Okay, good, Sarah. You can't hold it. Something you can't physically touch or see. Yep. Oh, Melissa, that's a good intangible asset. Solar energy. Now, if I can't see it, I can't touch it, why does it have why would it have value? Or why would I just gave you the answer. If you can't see it and you can't touch it, why is it in your asset section of your balance sheet? Reason being is it has value. There's something that has value that you can't see or you can't touch, but it is worth something. Solar energy would be one of them. If you can accumulate solar energy, um, and again, the solar energy would be the intangible asset, but that has value. That has value that basically may help you sell products or whatever, but it has value to your company, so it is an intangible asset. So what are some other items that we may have missed here? Again, it's non-physical assets used in productions. So yes, we can't touch it or see it, but it's used in our operations. We have the right to it, and seeing that we have the right to that intangible assets, that can give us a competitive advantage. Air rights. Okay, thank you, Sarah. Yep. Yeah, if we have air rights to broadcast something, that's an intangible asset. You guys are really thinking of some very unique intangible assets. Can have a limited or an indefinite life. So an intangible asset can go on as in an indefinite life, or it can have so many years that we do what as far as intangible assets, do we depreciate intangible assets? Yes or no? Heidi's going to say yes. Melissa's going to say no. Ooh, we got okay. Nicole is going to say no, and Sarah says yes. We got two yeses and two nos. Well, yeah, an indefinite life. We wouldn't actually. Uh, I'm going to get there, Melissa. Hang on to that one. But per the first question, you're not going to depreciate intangible assets. You're going to amortize intangible assets. So it's very similar, okay? I'm going to say that, but it's the language is different, okay? You're going to amortize intangible assets. You depreciate physical assets or tangible assets. You amortize intangible assets. And you amortize it by what it costs you to purchase it, okay? Now let me ask you another question, another trick question. Yes or no? I'm full of them tonight. Um, Computer software, is that a tangible asset or an intangible asset? I'm sorry, it's not a yes, no. It's either, is it tangible or is it intangible? Okay. Melissa's, okay. I got three intangibles and one tangible. Heidi, it is an intangible asset because yes, we can see a computer and yeah, that one's kind of hard to accept. I agree. But the software that's running the operations in that computer system is an intangible asset, and it is amortized over the life of the software. Good. And here are some other intangible assets. We've got patents, copyrights, franchise and licenses, trademarks. Again, you look at I don't have one in front of me, but if you look at a Coca-Cola can, you cannot copy their trademark. If you look at a McDonald's sign, you cannot copy that trademark. It is theirs. you will get sued and you will lose money if you try and copy the Coca-Cola uh, brand or the McDonald's brand. So if somebody has a brand and they trademark it, okay, you cannot copy it. Goodwill. What is Goodwill? Now I know Goodwill is a store where you donate your materials and they resell it and make a profit. What is Goodwill in the accounting world? This is kind of there was I don't know if you guys there was at a point where we were talking about the balance sheet of companies. There was a discussion question on this, and I know some students mentioned goodwill or the recording of goodwill. And I'm not going to go any. I'm just going to get your feet wet on this one. If you take my advanced financial reporting class, we will hit this in 3 or 4 classes, okay? But goodwill, when a company buys up another company, the first thing we need to do is to determine the market value of that company that we're buying. So let's say um, we are buying, a parent company is buying a subsidiary, and the parent company is going to pay $1 million to buy the subsidiary. So we look at the fair value assets of the subsidiary, and we find out that the fair value of the assets are worth 900,000. The parent's paying $1 million to buy $900,000 worth of fair valued assets. The difference there, the $100,000, would be considered goodwill. Goodwill has an indefinite life. So again, that's all I'm going to talk about as far as goodwill. However, if you ever hear about this term in the accounting world, you'll know that it's payment in excess of the fair value of the purchase of a subsidiary. Okay. Other items on here. Anybody out there have a research and development department in their firm that work on prototype equipment? Oh, Nicole does. Good. March & Schmidt does have a research and development department. We work on kind of new things, try and stay ahead of the competition. And we bring to the table some different things that other companies don't have yet. And we're always brainstorming and putting things together in our research and development department. And apparently, research and development is knowledge, which is an intangible asset. Now, what we put together would be a tangible asset, and that would be depreciated. But the knowledge gained to acquire, to put something together, costs money, and that's intangible. So that would be an intangible asset. Excellent. So again, we have listings here of different intangible assets. Intangible assets then are amortized most often on a straight line basis. So if you invent a machine that no one else has invented yet, anybody ever watch Shark Tank? Heidi has. Good. Oh, Nicole has too. Good. Good. Yes and no, Nicole. Okay. If you notice on Shark Tank, the when the people come in and they're looking for money from the sharks, they've invented a new product. And that's what the sharks want. They want to see what you, as a savvy business owner, can invent and produce and create and sell to the market. And one of the questions they're going to ask these individuals that are looking for money is, did you patent that product? If you've patented that product, um, no one can mimic that product that you've just patented. So you have rights to that, almost like a monopoly. So that's why it's important that if you invent a product that you want to sell to the public, make sure it's patent, so no one else can make a duplicate of what you've just created. Copyrights are the kind of like for recordings of music. If you are Taylor Swift and you've if you were Taylor Swift, okay, and you record music, and there's a song that's hit #1, and you don't want anybody else to record that same music, you're going to have a copyright. Okay. Um, Basically, groups will have copyrights. No one can copy the group name. So if I'm trying to think of a group name here, I know there's a lot of new ones out there that I'm unaware of, but I'm going to go old fashioned here and say the Rolling Stones. There's no other group that can be called the Rolling Stones because that is already copyrighted by the group in the UK. Okay, again, I'm going old fashioned there, but that's the only that's the one that came to my head. Okay, so again, they're valued, they're worth something. If if I patent a product, there's value there. No one else can copy that. If I have the Coca-Cola trademark, no one can copy that. That's mine. There's value there. Okay, so that's why we amortize intangible assets. And we have to determine then how many years that patent's going to last, or how many years that copyright is going to last. Um, in order to amortize it, we need to know a number of years. The Coca-Cola brand, I mean, has been out there since the invention of Coca-Cola over 100 years ago. So you can see how some of these patents and copyrights can last a long, long time. How do we amortize that? And again, the companies have to decide, well, I've got this patent here on this product. How long is that patent going to last? How long do I want to keep this as my own? Okay, 20 years, 25 years, 30 years. Just take the cost of that patent, which is not cheap, the cost of that patent divided by the number of years, and that's what you're going to amortize it for on an annual basis. Very similar to a straight line depreciation method. The only thing now is you're taking the cost of the patent and amortizing it over the years of that patent. Copyright, the same thing. Franchise and license is the same thing. Again, goodwill, I kind of define that for you as the amount by which a company's value exceeds the value of its assets and liabilities. It is a indefinite life, and if an intangible asset has an indefinite life, it is checked on an annual basis for impairment. If for some reason that intangible asset like goodwill has been impaired, you have to reduce the value of that goodwill. I'm not going to go any farther into that. Okay, there's other things here. Right to use asset, it's an intangible asset. Right to lease or rent property. The right leasehold improvements, improvements in the leased property paid for by the lessee. Other intangible assets, software, there it is. There's that other one. Non-compete covenants have value. Customer lists have values. So you're you work for a company that has customers. That listing of the customers is an intangible asset. It has value to it. Research and development, then, again, are expenditures to discover new products, processes, or knowledge. Costs are expense when incurred. They're not depreciated. GAAP does not include them as intangible assets. Okay. Any questions on intangible assets? In your case, just remember the familiar ones, the trademarks, the patents, the franchise fees, or copyrights. Okay. Remember the main ones, know what we need to do as far as amortizing them. And that's about as far as I'm going to go in this class as far as identifying intangible assets. So, and then be aware of the fact that intangible assets, they're listed after your tangible fixed assets in your balance sheet. Tangible assets are long-term assets, probably the last items you're going to see in that balance sheet. Okay. So with that being said, let's look at asset turnover. That is going to be our flavor of the night. Asset turnover is going to be net assets, or excuse me, not net assets, net sales divided by average total assets. Do we want this to be a large number or a small number? Do we want to be a Starbucks, has larger asset turnovers, or a Jack in the Box, which has a smaller asset turnover? You want to be Starbucks or Jack in the Box? Heidi says large. Nicole says large. Sarah says large. And Melissa's going the other way. I think Melissa's going smaller. Actually, everyone, okay. Actually, Melissa, you're not incorrect, but for the most part, we want to make sure our assets are generating more and more and more sales. How efficient are our assets doing for us in our operations? So assets are as assets work for us, they should be generating more sales for us. So that larger net sales divided by what we have in assets, you want that to grow. However, Melissa, you're not incorrect. There will be certain years where we have to um, revitalize our asset structure. We will want new machinery, new equipment, new whatever, because we need to bring in state-of-the-art equipment to generate more and more and more sales, because the equipment that we have, the sales are going to start to become weaker because we don't have state-of-the-art machinery. So there will be certain years where Melissa is correct. You're going to see a lower total asset turnover, but hopefully that can rebound in the following years and grow and grow and grow, because now our state-of-the-art assets are generating more and more and more sales. So it's one you want to play with, but yet you want to see these assets generating more sales. And thank you, Melissa, that's where I was going. That makes the most sense. Your assets are investments. You want them to make more and more and more sales. You want them to generate more sales. And the higher that sales, the higher your turnover. But every now and then you need to turn over into new assets, and you're probably going to have a lower asset turnover followed by a larger pickup in the years to follow. So everyone was correct there. There was no wrong answer. All right. Any questions on asset turnover? It's important for companies to determine this in order to see if their assets are generating more revenues on a year by year by year basis. Good. Thank you, everybody. All good. Thank you, Nicole. That's that smiley face. Excellent. All right. Let's just getting there. Let's talk a little bit about Appendix 10A. Exchanging plant assets. Okay. Sometimes we exchange one asset from our company for another asset from another company. Okay. Machineries, automobiles, office equipment are exchanged for newer assets. Okay. In the exchange, a trade-in allowance is received on the old assets and the balance is paid in cash. So if we are trading assets from one company to another, we may be getting less valued assets from that company. We're going to want to see some money up front to kind of even the exchange out. Be aware of the fact that some assets, accounting for these exchange will depend on whether the assets have commercial substance. Commercial substance implies that you're going to acquire future cash flows, or your cash flows will be altered. So if you basically, if you sell machinery and buy better machinery, the better machinery is going to generate more sales, going to increase your cash flow. Your cash flow is going to be altered. So that's what commercial substance is stating. Okay. So in that case, if a transaction has commercial substance, we can record a gain or a loss. So again, here we have a machine. We have a company acquires 42,000 in new equipment. It exchanges it. It pays $33,000 in cash and trades an old machine that costs $36,000. That has accumulated depreciation of 20,000 and a book value of 16. The exchange has commercial substance. It'll alter the cash flows in future periods. The old equipment has a trade-in allowance of $9,000. Again, if it's a loss, the market value of the asset received is 42,000. First bullet point there. The equipment we're giving up is worth 16,000. That's the book value, and we're paying out cash of 33,000. So 33,000 plus 16,000 is 49,000. Well, that's greater that we're giving up than what we're receiving. We're receiving $42,000 worth of machinery. We're giving up $49,000 of assets. That's going to show a $7,000 loss. On the other hand, if we're receiving $42,000 in assets from another company and we're paying $16,000, or excuse me, we're giving up equipment with a book value of 16,000. We're paying 23,000. Now the 16,000 plus the 23,000 is 39,000. We're getting assets worth 42,000. We're giving up 39,000. Now we have a gain. And the only time we show a gain or a loss is if it does have commercial substance. If it does not have commercial substance, we don't show a gain or loss. And here's the journal entry. Again, equipment new of 42,000. That's on our books now. Loss on the exchange of the asset of 7,000. Losses are debited. We have to get rid of our accumulated depreciation of the old machinery of 20,000. So we debit that out. Credit equipment that we sold for 36,000, pay the cash of 33,000. So that's for the loss, that would be the journal entry. And then here would be the journal entry for the gain. Again, we got equipment for 42,000. Accumulated depreciation, wash the 20,000 out. Get rid of the equipment of 36,000. We don't have it anymore. Pay the $23,000 in cash, record or squeeze in the gain on the exchange of the asset. All right. Any questions on that? Again, look over that appendix. I think it's important for us to understand what commercial substance is and then how that works within our journal entry. Excellent. Good. Any questions on chapter 10? A lot of stuff. Again, I do apologize. A lot of stuff. Oh, by the way, my second favorite ice cream, I forgot about that. My second favorite ice cream is mint chocolate chip. So who was ever going to, now they have to watch the whole recording in order to get both of my ice cream flavors. So again, my second favorite ice cream flavor is mint chocolate chip. All right. Any questions from anybody? All good. No questions. Thank you, Nicole. Thank you, Heidi. Thank you, Melissa. Thank you, Sarah. Great. Well, you guys are done. So next week, you won't see me next week, Thursday. I will see you in 2 weeks from now. So our next class lecture will be March 28th. I will put your participation points in, and I will update those. If I can do it tomorrow, if I can, well, I'll do it now. I got to update those, that homework and that quiz. So I'll do that right now. But again, you guys have a great night. Have a great 2 weeks. We'll see you in March. See you on March 28th. Good night, everybody. Thank you. Thank you. Yep. Thank you, Melissa. Thank you, Nicole. Thank you, Heidi. We'll see you in 2 weeks.